Today I'm going to talk a little bit about the People's Bank of China gold reserve announcement because there's been a lot of buzz and disappointment about it. First though, I thought it would be fun to play a little game to illustrate an important point and to get your head into the right space to digest the China discussion. Let's assume that you have a magic machine that gives you perfect predictions of market prices a year into the future. Further assume that you have the option of putting all of your wealth into one of three investment vehicles. Sure, I know that there are more options, but let's make this simple for the sake of the game. You can put all of your wealth into gold, stocks, or dollars on deposit. Currently the market price for gold is $1,134 per ounce, and the S&P 500 is priced at $2,127 per index share. Your magic machine predicts that the market price of gold a year from now will be $1,260 per ounce. The S&P 500 will have a market price of $2,446 per market share. In other words, the price of gold quoted on the market will increase 11%, and the price of an S&P 500 index fund will increase by 15%. And you know this with 100% certainty. I know. Most of you are saying that it's impossible to know what the price of any asset will be with certainty a year into the future. But there are a few who are so delusional that they have the confidence that they can. Let's just hop into that boat with them and play the game, assuming that our machine has perfect foresight. So, what asset do you pick to hold all your wealth? Do you go with gold? Do you go with stocks? Or do you go with cash? Take a moment to think about this and make your decision. A few of you are probably asking whether or not changes in the purchasing power of the dollar are going to affect which choice is best. That's a good question. Let's see if changes in the value of the currency affect which assets are the best to hold. After all, it's ultimately what you can buy with your savings that matters, and not the quoted price, right? I've added a couple of columns to the table to reflect what the changes in purchasing power of each asset would be, assuming a 10% price inflation or a 10% price deflation in the purchasing power of the dollar. And by the way, as a side note, I'm using the word price inflation as it is generally misused by the economists to refer to the purchasing power of the dollar as opposed to the correct use of the word inflation as a reference to the change in the supply of money and credit. But with that said, let's continue. You'll note that if the dollar loses 10% of its purchasing power, the dollar is obviously a loser. Most of the apparent gains in gold and stocks will vanish. What looked like an 11% gain in gold only holds you even when it comes to purchasing power. And what looked like a 15% gain in stocks becomes a meager 3.5% gain in purchasing power, which probably vanishes after you pay the taxes on the 15% phantom gain. Still, if we ignore taxes, stocks look to be the best place to be, which is what your magic machine told you. If instead the dollar increases in purchasing power by 10%, the price gains in gold and stocks understate the actual change in purchasing power. In the case of gold, the purchasing power increased by 22%, and the purchasing power of stocks increased by 26.5%. Stocks again would have been the better holding. Thus, we can see that whether the dollar increases or decreases in value, it doesn't change the asset that you should pick in this game. Yes, I admit that this is a pretty brain-dead game. Let's make things a little bit more interesting by playing another round. We'll use the same starting point, the same market prices as the last round, but this time your machine predicts that a year from now the price of gold will be 50% lower than it is today. By contrast, the price of the stock market will be 15% higher than it is today. Which asset should you pick? Take a moment and give it some thought. Okay, have you made your selection? Good, let's proceed. You probably knew that there was going to be a twist, and there is. Let's talk about this twist. Imagine that you made your choice. You might have purchased some gold coins. You might have also opted for gold but selected a proxy gold investment, such as shares of GLD or the Central Fund of Canada, or maybe even BitGold or gold money. Maybe you decided to purchase index fund shares such as Select Share Spiders or the Vanguard S&P 500 Index. Or Maybe you're holding cash on deposit somewhere, or even keeping some cash at home in your safe. Whatever you choose to do with your wealth, your selection is made, and you are living your life over the course of the year and watching the market tickers with interest, with dreams of all of the stuff that you'll buy with the gains that you'll accrue after your machine has proven again to be right. As the year wears on, you notice that the dollar strengthens in purchasing power. It continues to strengthen day after day. The price of most commodities, including gold, decline as the dollar gets stronger in purchasing power. Interest rates continue to hold at record lows, and corporate executives respond by borrowing cheap money and buying outstanding shares of their companies on the open market. So day after day, commodities go down, but stock prices go up. If you bought gold, you are obviously distressed. But if you bought stocks, you're obviously elated. As the year wears on, there are signs of obvious stress in the credit and labor markets. Tax revenues decline, and many municipalities declare bankruptcy. They manage to restructure their debt and also get their obligations to pensioners reduced. Corporate revenues also decline, and many of the companies who were buying back their shares end up having to cut their dividends, and some even declare bankruptcy as they struggle to have enough cash flow to meet their debt payment schedules. The Federal Reserve, having held interest rates at zero for 6 years now, has very little else that they can do to stem the tide of bankruptcies. They want to inflate the currency desperately and depreciate the value of the dollar, but the market seems to be more powerful than they want to admit. The dollar's purchasing power doubles over the course of a single year, making most debts unpayable. Suddenly, one Sunday morning, Jack Lew and Janet Yellen hold a press conference. They make an announcement that nobody saw coming. In order to alleviate all of the debt problems, they are going to enact two radical measures. First, they are going to introduce a new version of the dollar. It will look very similar to the old currency, with the exception that all of the presidents' faces will be replaced with more politically correct historical figures, of course. They state that the old currency will no longer be used. The new currency will be the only one honored. They will replace every current dollar in circulation and those on deposit with 4 of the new dollars. This makes everyone quite happy because they get the heartwarming feeling that they are getting more, not less. The second measure seems very odd to most, but they shrug it off as unimportant because most people don't hold gold. What they state is that they are going to open the mint to the free coinage of gold. The mint will offer to buy gold in unlimited quantities for 10,000 new dollars for every ounce brought to them. The owner of the gold can opt to have their gold minted into a new 1-ounce coin with an official $10,000 mark stamped on it. Or, alternatively, they can choose to part with the gold and take away $10,000 worth of the new cash. Again, most shrug off the news as insignificant because most people don't hold any gold. Sunday dinner conversations around the country bring lots of interest and lots of talk about what to expect in the coming week. Monday morning rolls around, but this isn't a typical Monday morning. The markets fail to open. Unfortunately, the news proved to be too much for the market participants to digest, and so all bids on stocks, as well as gold futures, are withdrawn. All asset classes on the markets go bidless, and the only price that people can see is the price of the last trade that was executed on the Friday before what we might call reset weekend. Now let's get back to our game. What's the final outcome? Well, if you held your wealth in stocks, you now have zero purchasing power. Sure, the markets will eventually reopen and you will eventually be able to sell your stocks for something. But for the immediate future, you have no access to your wealth if you held it in stock form because nobody's bidding for it. It does you no good that you see the last traded price of $24.46 highlighted on Yahoo Finance. Nobody is offering to buy from you at that price. Hopefully you didn't choose to hold your wealth in dollars. You would have been very happy leading up into reset weekend because you've watched as your purchasing power continued to go up. You felt wealthier every day. Unfortunately, what you are finding now is that despite the fact that you now have more dollars in your bank account and your total holdings now buy half of what they would have at the beginning of the year. So the good news is that your bank will remain solvent and that you'll have access to your wealth. But the bad news is that you took a pretty severe haircut in terms of purchasing power. Now, you gold holders are in pretty good shape if you hold physical gold. You can get all the currency that you need by taking your gold to the mint. The unlimited bid represented by the mint's offer has now set the price of your gold at 10,000 of the new dollars per ounce. So even though the new dollars buy less than the old dollars, your gold has actually increased in purchasing power by almost a factor of 3. Hopefully you held your gold in physical form. Those of you who held digital gold will have to wait and see if the markets reopen to find out what, if anything, is left of your wealth. For now, though, you have no purchasing power because you have no access, and you're faced with a total loss, at least temporarily. Now, the point of this exercise was simply to show you that definitions matter a great deal. One of the fundamental flaws of currency, whether it's fiat or not, is that its definition can be changed by a sovereign government anytime it suits them. Don't believe me? Look at what the US did to the dollar in 1873, 1933, and 1971. Each of these times, the definition of the dollar was changed. So is my little mental game so much of a stretch? You be the judge. What you need to take away from this exercise is that definitions matter a great deal. An ounce of gold will always be an ounce of gold, but a financial claim on gold is not the same as an ounce of gold in hand. The Forex gold quote is not the same as the price of coined gold, and the dollar will not necessarily always be defined in the same way. So you need to be very careful when you read into any news story. Speaking of which, let's get to the People's Bank of China announcement. Here's an article in Bloomberg News about the announcement. Bear in mind, this is the same Bloomberg that predicted a massive increase in China's gold holdings. Lots of experts were expecting their gold holdings to come in somewhere between Germany's and the United States, and they were surprised by this news. Here's what the news story had to say. It says, China ended 6 years of mystery over how much gold it's holding, revealing a 57% jump in reserves, overtaking Russia to become the country with the 5th largest stash of metal. The market has been speculating on the size of China's gold reserves for years, and the central bank has always been reticent until now. Fu Peng, a portfolio manager at Lijian Global Macro Fund Management Company, said by phone from Beijing. China boosted bullion assets to 53.31 million troy ounces, or about 1,658 metric tons, the People's Bank of China said in a statement on Friday. That's up from 1,054 tons in 2009, when it last updated the figures. The U.S. has the biggest reserves at 8,133.5 tons, data from the World Gold Council show. Let's focus on a key word. Notice how the word reserves keep getting used. You should take a moment to look up the definition of foreign exchange reserves. Briefly stated, foreign exchange reserves are assets held by the treasury and banking system of each country participating in international trade. These assets are used primarily to settle trade. Since the dollar is the world reserve currency and used in the settlement of most trade, you will find that a significant portion of currency reserves are in the form of dollars. Now, notice that China has merely stated that their gold reserves have increased to 1,658 metric tons. Does this mean that they were not importing all of the gold that was being reported for the past few years? I've seen estimates that between domestic production and imports, China has increased their ownership of gold by at least a couple of thousand tons per year. Where did all of that gold go? Well, as I've said, definitions matter. One has to ask if all of the gold owned by a country has to sit in an account called foreign exchange reserve. I would argue that the answer to that is no. Let's see why. I've compiled here a table of foreign exchange reserves of several major world economies. Some of the foreign exchange reserves are cash, and some is gold that's allocated as such. You can take your time and examine this table more thoroughly anytime you like. I would just like to point out a few important features. You'll notice that the US, which produces the world reserve currency, only has 3.5% of the total world's reserves. The reason for this is that the US doesn't need to have more. So much trade is conducted in dollars that we don't need to hold much in the way of other countries' currencies. What we do need, however, is lots of gold as a just-in-case measure. Now, go down and look at Saudi Arabia. Although Saudi Arabia has a huge export oil business and is a much smaller economy than the US, they hold nearly twice the foreign exchange reserves of the US, and most of it is in currency form, not gold. To most, this would seem to be an oddity. I've shown in the past videos that the House of Saud has imported multiples more gold than is reflected by their officially acknowledged gold. Where did it all go? Well, the answer is that the gold a country owns does not have to be held as a foreign exchange asset. Saudi Arabia has several sovereign wealth funds set up to manage investments from all of the trade surpluses that they've accumulated over the years. These wealth funds hold many investments, including gold, which are not publicly disclosed. They don't have to be, especially in the case of gold. Saudi Arabia has ample currency reserves to handle their international trade, which is why only 2% of their reserves are in the form of gold. And the same goes for China. Take a look at their total exchange reserves. They are absolutely mind-blowing. Nearly a third of all of the foreign exchange reserves in the world banking system is in the hands of the People's Bank of China. They don't need to include gold as a reserve asset. There is little chance that they would ever need to mobilize it to facilitate international trade, unless there was a big problem. So where is all of their gold? Well, I suggest again that you look up Sovereign Wealth Fund. Further, I suggest that you look up the China Investment Corporation, which is China's premier sovereign wealth fund. If you do this, then you'll probably see where all of the domestic gold production and gold imports have gone. They don't need to classify it as a foreign exchange reserves, at least not yet. And the truth about the announcement is all in the definitions. On the other hand, they have accumulated lots of dollars and dollar-denominated debt. So China does need to have lots of gold as an insurance policy against the scenario painted out in round 2 of our earlier game. China is fully aware of the arbitrary definition of the dollar. They are also fully aware that we have already changed it 3 times over the past century and a half. Definitions matter. They matter a lot.